So, without further ado, I'm now going to introduce you to our incredible team of panelists over here. Our first panelist on my right-hand side of the edge is Paul van Niekerk. He's a strategic leader with a master's degree from Stellenbosch University, with a master practitioner in real estate, and he combines expertise of his IT training and real estate, leading successful teams with a focus on problem solving and creative growth strategies. So, please welcome Paul van Niekerk. You guys can clap if you like. Get the other guy. Just so that our virtual audience knows that there's real people out there. Paul, over to you.
Thanks, Neil. Evening, all. Paul van Niekerk. I'm the Director of Real Estate Assist and then also the Principal. And I manage the sales environment as well as the rental environment within the property sector for our companies.
Awesome. Great. Welcome. Next to Paul, we got Rudolf Mathieu. He's our tax expert. He has over 10 years in accounting, tax planning, insights into tax consideration, particularly for property investors. And we're really invaluable. So if you've got those tax questions, line them up. We'll deal with them. He's had extensive experience across various industries and brings a wealth of knowledge to the table. So please welcome Rudolf Mathieu.
Thanks, guys. It's really good to be here. I'm a partner in a financial accounting and tax advisory firm. And I'm glad to be here.
Wonderful. Great having you. And then, of course, Gerrit van der Westhuizen, who's next to him. He's the Chief Investment Officer at Wealth Assist, and he brings over 30 years experience in financial planning and property investment. Most important, because there's not many financial planners that can do property as well. Gerrit is certainly one of those. He's dedicated to fostering very strong client relationships and financial security. So making sure that you get into the right investments and you don't make those silly mistakes that a lot of people do. So please welcome Gerrit van der Westhuizen.
Thank you. Thank you, Neil. I appreciate to be here. I'm heading up, as you said, the investment side of the business and the team inside, and we are really fortunate to assist you that I can tell you tonight. Thank you very much.
Wonderful. Great having you again, Gerrit. And then, of course, last but not least, we've got Daniel Lombard. He's the CEO of the Assist Group. He's driven by vision for social and financial impact. And he's a seasoned property developer. So please welcome Daniel Lombard, everybody.
Thank you. Yeah, I'm in a bit of a different role here tonight. So tonight I'm actually here to speak from an institutional investor's perspective. So my role tonight is more a director of Turning Point Property Group, which it is where all the institutional investors' money are invested through. That's the vehicle that we use for that. And that specifically is for banks, ultra high net worth investors, those type of guys. And my message tonight, or what I would like to bring across, is why Turning Point uses, in this situation, Wealth Assist as their product provider for the last 3 years. How do we look at the risks and those type of things? And obviously, on the end of the day, also, if you understand, Paul's going to share a bit about how big the need is in this market, how big a demand there is from a property owner's perspective. And then on the end of the day, for us to actually help just a very small percentage of them, we can't do that without institutions. So we need that money. It makes it slightly more affordable than just private investors. And it obviously places us in a position where we don't have to just help 10 or 20 people in a month or arrear mortgages and that type of thing, but we can rather push the numbers up as soon as we're ready to scale with that kind of funding.
Thanks, Neil. Thank you so much. I think we're getting involved into investing, but what are we investing in? And we're investing in people that are in the distressed property market. So what does that look like, and how does it appear when they arrive on our doorstep? What does this real estate owner actually look like? Because these are the people that we're trying to help. So there are a number of things. Firstly, arrears in the bond. These are property owners, so we find that there is arrears there. We find that there's arrears in the municipal account. There might be multiple debt, loan accounts, credit cards. We often find that the vehicles are in arrears as well. There's a toss-up between being employed and unemployed. The situation might have arisen as a result of losing his job or just bad decisions. And then obviously underscoring all of this is credit impairment. And that is the reason why they can't go to the traditional method of going back to a bond for debt consolidation, because the credit scoring is impaired. So this is the type of person that arrives at us saying, okay, we need help. How can we help these people? So very importantly, what you will see in our environment, we have typically two scenarios that we can do. The first scenario is what we call a typical is a recovery. And what we would do in that scenario is the person would be able to retain his house. The second scenario is one which is called an on-sale scenario, and that is where there's no other option but to sell the house. Now, within a recovery solution, we look at the person has got income, they've got rental affordability, and they're able to recover from a credit perspective within a year to 3 years. Our average transaction duration is around about 2 years. In the on-sale scenario, we find that that person might be unemployed or does not have the ability from a financial perspective to actually buy that property back. So then we still aid that person by unlocking some equity in certain cases, and then to help them address and get that credit scoring back to where we wanted to get from that perspective. So those are the two scenarios, and there are some variations on the theme within both those environments, which we'll touch on a little bit later. So how do we assist the distressed owner? So if we look at from a property perspective and a bond perspective, what we do is we see if there is available equity within the property itself. In other words, the difference between the market value of the property and then the bond itself. And that is the market or the area in which we target to try and assist that person. We'll also most certainly look at settling the municipal account. We want to settle all credit cards, and you will see and notice that all our decisions that we make at the end of the day goes to underscoring improving the credit rating. We can't improve the credit rating and then helping that person to actually recover. We're sitting in a situation where we're not helping that person at all. We also understand that given the scenario that we won't be able to help all people, but we must certainly have always been able to provide a solution for that person, even if it's just a mindset change as well. So we always want to see how we can improve the situation and leave that person in a better place afterwards. We want to ensure that the vehicles are paid up. Sometimes there are decisions that need to be made, and we help giving enough information that that person can make an informed decision. Then a recovery, depending whether the person is employed or unemployed, that will decide what type of transaction we're going to do between a recovery or an on-sale transaction. And then lastly, obviously, within that year to 2 year period, we have a team that works with the real estate owner to improve the credit scoring. So we track the behavior on a monthly basis. We want to ensure that they're making the correct decisions. And that is how we get to assisting the distressed owner in totality, which is very, very important. This slide just talks to the need for within the South African market currently, and the stats are quite hard, or they're hard hitting. 35% of South Africans have their own dwelling. We also see that 5% of a 75 billion bonds are in some kind of distress. That means 120,000 odd bond transactions are in distress at the moment. So what does it tell us? It says the size of the impaired residential property market is huge. And do we have enough investors? Most certainly not. So we have a lot of work to do. We've got a lot of people to help, and we need to get out there and do it. So the opportunity is great for investors to get in. We currently see the interest rates that are now becoming favorable. They weren't at a stage, and that's also exacerbated the problem that we have at the moment in terms of trying to address the solution. So that's who we are.
Excellent. Thank you.
Well said, Paul.
All right. So, Gerard, we're going to first, are we going to you down here before Gerard? I know there is a batting order here. So, over to you.
Thanks. Yeah. So, thanks, Paul. I think that stats speaks for itself. I think that's quite a big challenge that we face in South Africa for quite a while. It actually, if we start in COVID time, just to give you a bit of a background, from COVID time, it was about 57 billion rands worth of mortgages that was 90 days or more in arrears. Currently, it's at 75 billion, to just show you what happened from there. So it didn't actually go better purely because COVID, they dropped the interest rate, tried to do all kind of things, which obviously affected the market as well. A lot of people bought into properties at that stage and actually paid the price later, and also now become our clients, which is not what it's supposed to be. So from that perspective, we have looked at this and said, okay, taking the risk out of and the stress out of real estate, how do we actually do that? Now, my function tonight, working from a institutional investor point of view. Now, the first thing is with institutional investors, before they actually touch any type of investment, they do a proper due diligence on every company or whatever you do on the end of the day. Now, I think the first thing they look at is proven track record. And that was even TPG's challenge from day one, because nobody wants to give you money if you haven't got a track record. Fortunately, we have got a great track record from Wealth Assist over the last 11 years. And those who don't have that kind of stats, we will give them and might provide them to you. But I think our worst case scenario in any year was 16.95% return for our investors. And I'm talking net returns. And the higher one, I don't even want to necessarily quote, but it's substantially in the 20s during that term. So for the last 11 years, through all the different property cycles, all those type of things, that proven track record of returns was actually one of the reasons why we as Turning Point Property Group use Wealth Assist investment products through this phase. Secondly, risk mitigation. Guys, I think any investor wants the risk mitigation, but when it comes to institutional investors, where, for instance, our normal standard is 75% exposure to market value, they, for instance, want an average of 65. They want certain other criteria, which is even far worse than try to de-risk any transaction in what they do. So my role as a risk committee member on the risk committee of Real Estate Assist and Wealth Assist is also to represent the institutional investors there, looking at how we can actually de-risk those. And those policies have been tested, and we've got a proven track record over the last 11 years with Wealth Assist, showing that those risks are actually addressed through the years. Then, obviously, for us as a criteria, we always have a very important criteria, and that's, do we make a difference in other people's lives while we're making money? Because if you really think about the distressed industry, you can always, 90% of any distressed industry investor, normally, and I don't take it up wrong, just call it what it is, but are misusing a lot of people's misfortune to enrich themselves, which is one of the things that we don't want to do. Then I think a very important thing from institutional investor side is a robust investment principles and metrics that we work on. So I'm going to touch on some of those things so that you can understand as an investor, what actually are we looking at when we sit on a risk committee, approve a deal for you, okay? Because this is actually what it's all about. So number one, market risks, okay? So first of all, we look at the local market conditions. If you take currently at the moment, and I ask any person, what is the current market risks? We all know it's, for instance, very much in the middle of a buyer's and a seller's market, busy changing as we speak, with the interest rates start dropping, that type of thing. What is the valuations currently is, a lot of owners at the moment, if you see they expect a certain price for their property, they're not getting it. What is that differentiation on what is the expectancy, and how will that change over the next 3 to 6 months when interest rates drop? Those type of things important, the economic and interest rate environment, demographics. Who knows about migration? You read about it all the time. Cape Town everybody migrates to Cape Town, they say. But if you look at the actual stats, some people migrate from here to Gauteng for money. People who has got money migrate from Gauteng to here to have a easier life, so that type of thing. So all those type of things plays part of the risk in your transaction. Financial risks, for instance, the type of clients that we have, where it's a real estate owner versus a tenant. If you have a normal tenant, we all saw that in the time of COVID, they just put away their keys, pack their bags and go. Our clients and our tenants are previous owners who wants to become owner again of their own property. So during COVID, for instance, we had a minimal drop in repayment in that time. An actual fact, I think it's lower than 7% drop in our normal, let's call it the default side of things. Whilst at the same time, the same thing happened with the whole rental market. The good standing tenants dropped from 83 to 62%, just to give you an idea. So those type of things are very important for you as an investor to look at. And you must have somebody to have at least that expertise to assist you in that. Then obviously making sure that you, I'm not allowed to mention names, but my one investor here tonight in person, we shared a lovely time with him and he said I can mention it as long as not his name. He sits with a lot of properties, but he's paying in 35,000 Rand a month. Okay, so if you look at those type of things, is that a good investment? We are redoing his portfolio because that doesn't work. Property, you're not supposed to, a good investment. You're not paying in monthly, even if you mortgage. Okay, none of our transactions that Wealth Assist produce for us are cash negative from day one. They're all cash positive, even if you finance them 100%. Okay, so those type of things are important. Property specific risk, location, property condition. Wealth Assist gives you a full-on report of those type of things. How sellable is the property? Because that brings the liquidity. If you can't sell your property, and that's where Paul is in the company, specifically focusing on that part, making sure that the properties are sold. Tenant risk, review the tenants. You spoke about that from that side. Then regulatory compliance. Does all our agreements fall within the laws? How do we do that? Is the legal issues addressed? Tax and insurance cost on every transaction, is it built in? How does it work? Those type of things. Then one that I would like to stand still at is exit strategies. We at least have always about 3 exit strategies. Just on our recovery products, if the client can't buy it back, then it's going to go into the market. If it doesn't sell within a certain time, you can actually hold on to it at a discounted value. Various exit strategies, making sure that you are not tied up in a transaction where you can't exit. Okay. Then your sensitivity analysis, stress testing, what's the interest rate? Like for instance, when we qualify a tenant or a previous owner to buy back and do those type of things. If he can't buy back at the current interest rate plus 2%, and now qualifying for it in the future, then, for instance, we won't assist him. Things like that. We look at all those type of things, and then obviously our pricing for every property deal that we buy from Wealth Assist products have got a specific price with the property. If there's a default, will be listed at what prices can be accepted. All those type of things are broken down in the agreements and addressed. Then strategic alignment. Every investor has a different approach, different goal with what he wants to achieve with his investment. And the only way to actually do that is we need to look at what's your plan. And that's where Gerard and them's role come in, where they actually take your situation, work out a full plan for you for the next 10 years, seeing how you can achieve that goal that you actually want to achieve. Obviously, diversification, different type of products, as we said, on sale, normal transactions. You can also invest through certain of our vehicles, like TPG, where you can participate in larger investments, that type of thing. And I think lastly, but not least, after COVID, we've all realized that there can be some economic shocks, 2008, pandemics that we have to deal with, and all those type of things need to be taken in consideration before you actually participate in an investment. Summing it up, conclusion, great thing with what we like as Turning Point Property Group, from an institutional investor's perspective, which should be your way of looking at it as well, is we have a crack team in your corner. People who actually go there making sure that all the homework is done properly, the risks is mitigated, those type of things are done, and all on the end of the day, not for you to spend months and days trying to work all that out. And I'll be honest with you, when I review every transaction on the risk committee, I don't spend more than an hour. Okay, that's good returns for my time, my investments, because all the reports that I've got available, if I go through them, takes me an hour and I can make a sound decision on that investment. And I haven't lifted my finger to go out somewhere, try to get a property that takes me, go visit and have 15 auctions to attend before I buy one. All those type of things can help you to make a proper investment.
Great, thank you, Daniel. I think so. So instead of doing the solo thing, you've got a team right over here to assist you every step of the way. And yeah, there's a time when somebody gets into a distressed situation and they panic. And in fact, if you don't do anything about it, it's just going to get worse. So reach out to the Wealth Assist team. Karat, you're going to take us through the hand-holding process of this.
Thank you, Neil. Yes, but I was thinking, yesterday I was listening to a report on the radio from TPN, and they suddenly made mention of what they called a squatter tenant. And I thought, what did they say now? And between 3 and 4% was squatter tenants. And I mean, it's big numbers. I thought now, and then they gave the definition of saying between they all in month 4 not paying their rent. That's a squatter tenant.
Okay.
Now, I mean, we haven't got an attorney here tonight, but I can tell you the cost of settling that matter is very high. And I think that's one of the things that we can chat to you about on the mitigation of risk specifically. So, yeah, as you normally know, Neil, I just throw in some stuff there. But, you know, every investor that I start to speak with, or many of them actually say to me, will you please help me to become financially free? And that made me think of this question that was asked to 2 blokes. And the one was earning 3,000 Rand per month, and the other one was earning 100,000 Rand per month. And they asked him, how much is enough every month? And they both gave the same answer. When I have enough money left after I've paid off all my accounts. So the reality is excess cash flow. I don't know if you know the feeling, but I mean, if you've paid all your bills and everything is sorted and there's money left, I mean, do you feel good about it or not? Well, both profile of income earners feels the same. And it was quite an extensive research. So, so I just wanted to say that people need to understand that it doesn't matter on what level you are operating on. You need to manage your personal finances to get in that position where you have some money left. So just very basic stuff, but for some reason people don't understand this. You have to start managing your finances. You can't manage what you can't measure, this bloke said. And I was just thinking about the simple operating system. The spreadsheet guys, there's a budget. Now I have a couple of friends, 600 square meter houses, 700 square meter houses, and so on and so on. And I can tell you, when I ask them, please provide me with your budget. So I've got this good friend who said to me, I've just calculated what my 3 sons, what's it, Duke? What? Diapers cost.
Diapers.
He said, he mentioned the figure like 15,811 Rand. And he says, how do you know that?
That's a budget.
He says, no, I've got a track record. built. I showed my wife. This is what it costs to put those thingies on them. So, but you know what? That's the guy that's living in the 700 square meter house. I don't know any friend that's wealthy today that hasn't got a budget. So a budget is very simple. It's income minus expenses, and then there's either a shortfall, or a surplus. And the key to it is, doesn't matter where you are. If you on your personal budget, on your business budget, or on your government budget, it needs to stay the same. It must be a surplus. And what people don't realize, and that's what I wanted to put out there. Remember, you are your biggest asset. Your work that provides an income to you is the start of your wealth. And, and we can go through, and that's why the government is so serious. We're going into this week into the midterm budget speech. No? Exactly the same calculation, just the notes are much bigger. No? So I just wanted to say to you, we need to create a positive cash flow on a consistent basis. That's an active management process while you're sitting in front of your computer. And the quicker you start, the better you'll be able to start growing your finances and your wealth. So what I was thinking about is that structured allocation of funds lead to a positive cash flow environment that enables you to save. So when I went to this bloke, friend of mine, who gave me that number, I said, can I use your template? He says, yeah, come, let's do it. And then I realized, okay, I first need to study Excel. And then, and then I saw this thing just below his budget. He had boat, bicycle, all the toys, year 1, year 2, year 3. So he started to save on his budget.
Yeah.
And that's why he was so keen on doing it, but there's a goal. So I want to say to you that before you can become an investor, you need to get into this discipline of managing your personal finances, putting money aside to start save consistently. That's the key. If you don't save, that means doing a couple of things which we can look into right here. The fundamentals to become a saver. No? Budget, saving, investing. So emergency fund, 3 to 6 months. Now, this bloke that I spoke to about the other one, of the 600 square meter house, I said to him while we were discussing his short-term emergency fund, he says, no, it's settled, I says, what do you mean it's there? Do you have it in cash? He says, no, I've got a 150,000 facility, overdraft, ready and available if I need it. I says, no, that's not the idea. To have your credit provider give you the fee. Go and save 3 to 6 months of salary into that account, in your savings account. Start adjusting your short-term savings by planning them and saving for them. Going into your medium-term savings plan. And then your larger savers. And I've made the calculation the previous time there in Joburg, when I spoke about the vehicle, how you can have R1 million cash within 7 years if you just do that thing that we don't want to do and not finance our vehicles, right? We can do that calc again for those who's interested. Retirement, education, and property is a long-term goal. Now, I think we're not going to go into that, but I just wanted to say, get your mind set right if you really want to be an investor. Because it actually starts with a basic, getting you into a savings mode set, and then going into investing. So,
just on that slide specifically, I think it's very important what you that this is literally what we are training our real estate owners to do in the process.
Yes,
becoming from a debt position to become an investor. I think it's important what you're saying there. Yeah.
Okay. Okay, there we go.
That's okay.
Right. So, management fundamentals of an investor. You'll remember in one of the previous webinars, we spoke about this lifestyle inflation thing. And it all starts with a amount of debt that you finance your lifestyle with. So, real estate owners comes to us because they missed this point. They're in real trouble. And now we have to start retraining them as well. But the reality is there's some things you can finance and there's some things you never should finance. Your lifestyle, you should never finance. Assets is a good principle, a better one. I tried to convince my wife about my car. She's not buying in, but I'm in it now, you see. When you sign the agreement, you're in it now. But at least I know the figures and there's a way to get around it. But then going into, so debt management is actually crucial when you want to be an investor. Investment management, that Daniel has now spoken about, understanding the risk, getting into it, getting the right players around you is actually crucial. And then, bringing in a guy like this, Rudolf, tax planning. Now, I'm telling you, I know for a fact that they can really save you money. They can help you up front to make the right decisions. And so the other day I was sitting with this investor. Now they've got the property or two in the trust. And the first question was, so where's your financial statements? No, what do you mean? I said, no, wait, I don't understand your question. What do you mean, where's your... The thing is, you need to get your ducks in a row and be actively involved, because that financial statement is representing what? Your budget, your cash flows. So if you want to get into this business of property, understand that you need to have your functionalities in place to have that operating system running in your favor. And then obviously, going into that process of monitoring the progress, reassessing. So we can have that discussion one-on-one. Finance that makes sense in property. Now, I don't know if you know, I mean, he was referring to a client of us who came in and said, listen, can you please help me? But last year I spoke to a guy that phoned me and said, listen, I'm paying in 23,800 Rand a month. I've got 6 flats, and I've got 3 properties in my personal name. I've signed surety for the company who's owning the 6. I says, well, just skip 1. The banks will come for all 7. And he says, really? I says, yeah. So he has got no, and the problem is he went and geared. So not all properties are investments. I don't know why people don't understand this. I hear that. You are a man that travels the whole South Africa. Please, will you please maybe answer me this question? Why do people believe that all properties are investments? It isn't. We need to do the figures to prove that it is an investment. So financial gearing only makes sense when you have a positive cash flow on them, in my mind.
Exactly.
And I got this picture specifically. Now, that word I actually did pronounce.
Trebuchet.
Trebuchet. I was thinking, if the guys in the 1700s knew this is what financial gearing looks like in their world, but in ours as well. You actually use a machine in warfare to hurdle something big over a wall. Now, when you use financial gearing incorrectly, you are in that seat. The one that's in that sling.
This machine.
You're not the machine. You think you're the machine, but you are not. So I want to please, guys, come and see us so that we can at least chat about your property portfolio, because in most cases, we can get you out of that seat in that sling so that you are not the one traveling over the wall. So we've built this new product solution that we call Restart. And it really will make a difference in your life. If you want to be an investment, if you want to use financial gearing, bonds and that type of thing, even for the cash guys, it's been asking, some of the investors has been asking for it. And I want to invite you. You can take a QR code there. We'll send it as well as part of the follow-up mails. But I mean, on the 12th, midday, 12 o'clock, we will have this launch for you, and we'll go into all the details so that we can explain to you how we restart the owners' life using their properties, but at the same time give you all the benefits that you want as an investor. So if you want to attend, please register and let's go a bit deeper.
Or call it a buy to let on steroids.
That's
Okay.
exactly what it is.
Buy to let with positive cash flow from day one, at not more than 85% of market value purchase price, with your transfer fees included. That's about it. Okay.
Speaking as a
So-
true investor.
Yeah, exactly.
Great stuff. So so that's it from my side. Neil.
Okay, great. So just take note of that date, everybody there, Tuesday, the 12th of November, down the QR code, 12 o'clock, and then you can find out how you can transform your property.
And it will be
investment.
short, like your normal.
Yeah, so like an
three
hour.
quarters of an
Yeah.
hour, more or less.
Yes.
So
Okay,
It's on
perfect.
a Tuesday, not to mess with any others.
Not our regular Thursday session. Great. Okay, so once again, I'm now going to hand over to our next speaker, Rudolph. He's a tax expert. He's going to be touching on tax. So, Rudolph, I'm going to hand over to you.
Thank you, Neil. You've been selling me big, as a tax expert. All right, so I'm just gonna do a really high level basics of doing investing in as an individual, as just starting out, and maybe using your company and maybe and inside a trust. So if you're just starting out, maybe doing one investment. I'm saying this because when getting into doing company and doing a trust, there are costs involved. So you might find that just setting up that whole structure in the beginning is going to cost you the returns on the investment is going to negate the cost will negate the returns. So this would be the way to start, just to buying a property or just starting in your own name. The slides, I realized that it's quite busy, so I'm just going to do it line for line quickly. So let's just say it's very basic. You are earning a salary, and you are just using your after-tax income to do an investment. Okay, so your tax calculation will look something like this. Other income less deductible expenses. Okay, that would be just your salary less maybe an annuity that you can deduct, and then after you've done your investment, there's return, and I've just said, okay, let's say you had a return of 100,000 rand, so total taxable income for you will be 450 for that year. So I just wanted to show that here on your 350, you're going to pay tax for let's say 55,000 rand for the year, and then now you have the 100,000 rand extra. That's going to cost you then an extra about 30,000 rand. So just because of the marginal rates, that will be what's going to happen in your own name. But still, I mean, as I said, that's not bad if you can make 100,000 rand and net to 70, that's okay. Maybe if you're a business owner and you run your business in a company, it might be easier to do an investment buying a property in a company. There are certain considerations regarding banks they are a little bit more difficult getting a bond in a company. There are certain things, and they don't normally give 100% bond. But let's say you have cash available and you want to buy a property in a company. So now you're sitting with an extra 100,000 rand in the company. It's basically taxed at 27%. I suppose we can talk a bit also about if you're a small business company, then it could work out for you. Let's say you've got a bit of a loss in your company, that you can use the loss against that investment income, but you're gonna pay 27% tax on that income. And just for doing for long term, I wouldn't really recommend it, because getting the money out is also going to cost you that 20% dividend tax. So if it's in the short term and you want to generate some extra cash flow, I think for the company to help the business, that would be a good idea. But if it's long term and you really want to take that money out and keep it, building your wealth with it, it's maybe not the best idea. Just like that, I'll get to a little example a little bit later that would be better. using a trust, so that I think your intent here is also very important. The trust is really an estate planning tool rather than a tax planning tool, but it does have some tax benefits to it, because you can basically invest in the trust. You use your income in the beginning, your money in the beginning, your personal money that you loan to the trust, and then you do your investments in the trust. It's registered in the trust because the trust is a legal entity, so that the company or the properties or the investments are actually owned by the trust. And then when there's taxable income in the trust, everybody says that a trust is expensive because you pay 45%. So what we then do is, according to your trust deed, the income is distributed to the beneficiaries via beneficiary loans, so that income is then taxed in their name. So you get to use all the exemptions and all their capital gain exemptions and those type of things, all of them. So that then really makes the tax liability there a lot better. So in time, this is the way we try to structure all our clients, wealth and their investments over time, because the idea here is to build wealth in your trust for I call it legacy assets. It's for your legacy, for your kids, for your grandkids. It's all in a trust. It's not in your personal name, so it doesn't fall into your estate. And that's really what you want. Otherwise, there's estate tax issues and so forth. So then, just as quickly, just the tax calculation for the trust then. So let's say the trust also has some investments. It has 350,000 Rand taxable income. You add another 100,000 Rand there. Now you're splitting that 450 up into three. Let's say it's your wife, your child, and then maybe another family member. You probably won't use yourself, like myself. My net or my tax bracket is a bit high. So for me, I wouldn't be a beneficiary of the trust in these things. But because the tax bracket is high, but your wife and your children, their tax bracket is lower. So and they all have interest exemptions, and they've got capital gains exemptions, and the bracket is lower. So you end up with let's say just the one child. The child has just the taxable income of 150, and his whole tax liability is 9,000 Rand times, let's say, times 3, because you've got the 450 split into 3, and that is let's say a total of almost let's say 28,000 Rand. Whereas in the beginning, you were sitting with just 30,000 Rand on that one investment and 80,000 Rand on that whole income. So that really brings down your tax liability. But obviously, with setting up a trust and doing that all type of things, there is cost involved. You have to have an accountant, to manage this thing, and do your financials. So this is why I'm saying, when you are serious about investing and trying to build wealth, then this is for you. If you're just starting out, I wouldn't make a decision now to go this way. Do it in your own name first, and then see how it goes, and see if you want to continue doing this, doing property, or doing any investment for that matter. And then in time start setting up a trust, and then in time start accumulating assets in a trust. So that's and then we are the guys that help you set this up and manage it for you. Make sure you're up to date with all your entities tax, and also with with the master and with CIPC. And I thought I'll just end off with a very hand scribbled personal slide. This is my structure, my personal structure. So I'll just quickly start from the bottom. So I'm a partner in a business. I've got 3 partners, and we do financial accounting. That is this is where our cash comes from, that business income. And us three, we've decided we would like to start invest in property. And because we're not a family, we are three business owners. We are these investments of ours need to be split into three. So we had to use a company that would be the middle block, a company to split it, because our family trust each own 3 parts of this company. So the company split into 3 shares, and our trust owns these shares. And this company now has four properties in there. There's income, and so we are building our wealth in that company. And the wealth then basically goes back to the trust that owns the shares of this company. And then in my family trust, right at the top, I own a property in that trust outright. There are some other unit trusts in there. There are some shares just listed shares investments in there. And so there's some income there in the trust that let's start on the left. My wife and I and my one business partner, we are the trustees of that trust, and we control the assets on that trust. And the idea of the trustees, we build the wealth. We are stewards of the wealth in that trust. We have to build the wealth and manage the trust for the benefits of the trust of the beneficiaries. And the beneficiaries of that trust is my kids and my wife and me. And so all the benefits of the trust will flow to those beneficiaries, and they get taxed. Well, the income there gets taxed in 3 parts. So I use all those three persons to distribute the income, and they are taxed at their lower rates and using all the exemptions. And so my partner on the left, on the right, they do the same for their families. So that's just personally how my structure is set up. I'm lucky. Let's say because I'm in the industry, I manage these things myself, but because I know the ins and outs. But because for the company, it needs to be set up. There's financials every year. There's a tax return every year. There's an annual return every year. So those are the things we do it as a service for our clients, that we keep. The books needs to be done. If you're VAT registered in your company, then and you want to maybe do a development there, that would also be a good thing. A good idea to buy property in the company when you're VAT registered. Then you can use that VAT the VAT registration to actually to get the VAT VAT claims and so forth. I think that's basically my story.
Yeah, I think it's gives you the options. I think very important, Neil, is just and you. I remember years ago we started chatting about the property ladder, what we call.
Yeah.
When you enter the property ladder, a lot of people make the mistake of, yes, I'm gonna be this great investor and that type of thing, which is the vision is no problem. Okay, but I think what Rudy is trying to explain here is take steps, because you haven't experienced it, you haven't done this. Do a few transactions, and especially if you do wealth assist transactions, what's fantastic is you're actually going to do a transaction which run for 2 years and it will be off your name. Okay, so now you can decide, okay, I've done 2 or 3 or whatever the case may be. Let's step. This actually works for me. Because if it doesn't make you sleep at night after the first one, maybe it's not your thing. Okay, doesn't help you land up building wealth in the hospital. So then it's only the family benefiting and not you. So
let me just come. I just want to say that I've found that many people who wants to get into property actually wants to be JSE property investors. In other words, I want to be in and out. I don't want to be called by anyone. Yeah. Don't call me and tell me the plumber needs to go out. No maintenance, please. I'm a busy man, that type of thing. So and that's what I call a JSE property guy. So he actually wants to be invested, but not necessarily a property manager. Yeah. And if you're in the property business, the true sense of the word, then you actually need to be geared for that. And I think
or outsource it properly on the end of the day.
Yes.
So if you are that investor that starts off, you should focus on doing it 1 or 2 in your personal name. Get to a point where you actually make the decision to build wealth, okay, through property. Okay, like me, no shares, no nothing. I'm a bit biased, like Neil says as well. I don't invest in other things. I diverse within property. But the bottom line is then you step to the second step, which brings you to the point where you now make a decision. Now you can either then go, as Rudy says, you can now either go, your second step is to decide, go take a company. We're going to use a company. Our trust is going to be the shareholder. Or if you want to build it up for instance, if you do wealth assist transactions, purely because it's a company there, maybe it's the right route. And if you've got 2 or 3 guys joining together, things like that, erect your company at that stage when you start doing 2 or 3 or 4 transactions at a time, that type of thing. And then lastly, when you get to the point, depending also on the way that you're going to travel as an investor, to have a passive income, for argument's sake. It doesn't mean that the vehicle that you're going to use today need to be the one that you're actually going to utilize until the day that you actually now get to the point where you have enough investment money to go and buy properties will give you that goal of 50,000 Rand a month, for argument's sake. So that is very important. So on that strategy is when Gerard sit with you and they do that planning, they look at all those things. Where do you supposed to start now? When should you jump ship to another vehicle? All those type of things together with the financial guys, look at that and give you proper advice to make a sound decision on the way forward.
Great stuff. So I think we can sum up, it's really running your property portfolio like a business. And that's what we want to do. And we want to become asset managers over those property. We're really managing the assets. Okay, so say to our audience, I see there's, you put a promotional slide there, subscribe to Real Estate Investor.
Oh, okay.
Thank you very much.
We see, but not the staff, not the clients yet. Now they see it.
Now they sing it. Okay, so there's a bit of a delay. But yes, so if you want to get lots of information every month, you can get Real Estate Investor. It's monthly, been running since 2007. All kind of insights on investment, these kind of questions that you're asking. We also run webinars. We do this weekly newsletter. Sign up for all of that. Just go to the rei.co.za website and you can get a lot of that. And as I say, encourage you to join, like these webinars that we've got right now. And
there's lots of others as
and
well.
There's so please engage with us. So I see there are questions, which is fantastic. And I noticed most of the questions are more around structures and trusts and all that kind of stuff, because I think you open up a can of worms there. Really.
I was afraid of that.
And I think that's exactly why you're here.
Exactly.
And then just one comment, I think just in terms of Rudolph's structure, I think he's also very personal to Rudolph.
Yeah.
And I think, for anybody out there looking at moving in that direction is to get the right advice. And it becomes personalized for you and your family and whatever your objectives are. Exactly. And I think that's the key point that we need to, and that's what we've got the team over here to assist you through that process. Okay, so let's get into the Q&A. So we've got Q&A. So please, the audience, if you also got questions, I'll give you an opportunity. I'm first going to deal with our virtual audience. From an anonymous attendee, are the distressed mortgages advertised anywhere if an investor wants to buy? So are you assuming there's a website or whatever? And do you want to do it without Wealth Assist? Yes, you can. You can do that. And I don't know whether you want to disclose that as well, Dania.
Yeah, I'll gladly disclose it. There is actually, the only way where you can actually get it is from the bank. And the problem for the bank is they can actually not give it to you because of the POPI Act. So you got a bit of a problem. I mean, obviously that's we do through our service advertisements, etc., and Tana's lots of hard work to actually mine these kind of things that gives us applications. I think we probably get 250 kind of applications, but that's hard work and it takes time. So if you want to go that route, you're welcome. It's any person that's really in trouble. Is there a source where you can find it? No. We've searched quite a bit, and we actually speaking to all the bank's top structures when it comes to legal action, those type of things. You can go to what's the website?
Well, it's also private property have a repossessed as well.
They've got repossessed, and you can go to My Roof. Those type of opportunities there, but that's like everybody's got access to that type of opportunities. I think what we have is getting the information prior to the legal action, getting to the sale and execution. And our goal is to actually stop sales and executions with what we do. So that's obviously, I hope it answers that question. I know it's a difficult one.
No, absolutely. Paul also wants to add just to that as well.
I think just adding to that, I think what's important to understand is that our environment creates a favorable environment for an investor with the real estate owner. If you contact that owner on your own regard, you're going to be stuck with a lot of resistance and getting access and trying to make that whole situation a favorable one for you. But through our platform, we actually create a very favorable situation, and the person on the other end is actually very grateful for our assistance because we actually put them on a better path. Whether we're selling, whether we're buying, whatever that scenario is one which creates a favorable environment for both the investor and for the real estate owner.
Yeah, I think it's important because also I think probably just response to this person. There's a lot of vulture investors out there,
exactly.
and of course somebody who's in distress is also very fearful, and they don't really appreciate getting approached by people who they don't know, who are total strangers. So working through this kind of process makes it a bit softer. It's more trustworthy, more tested. In fact, been through the stress testing already. So, and I know you wanted to add to that. As well.
Just saying in the sense of there's a different. I'll use a very practical example. When there's a sale and execution coming up, when I phoned the guy at that stage many years ago, when I did everything myself, I phoned them and I'm the 12th guy that calls. And he says, please, man, so many guys called me. I said, yes, have somebody asked you if they can help you to keep your home? Oh, no, when can you see me? Okay, so that's the difference. Everybody wants to buy his house for nothing, and we don't. So that already breaks the barrier. And then we are very open and honest with him in our consultations to actually help him to make the right decision. Because everybody else that approaches, even if it's the estate agent or whatever, they want to ask, can I sell your house? And most people would like to keep their homes, okay? The great thing is he provides us the opportunity to actually show him that it's not financially a good thing if you have to keep your home and you're paying the price later. So we do all that sums for them, but we have an objective approach. We're not here to misuse your misfortune. No.
Okay. I can just maybe be straight upon it. Just don't buy distressed properties if you don't know what you're doing. Around our risk committee, no, I'm serious. When I was approached by Daniel many years back, I said to him, just explain to me the risk. It took me 6 months to understand it. And now I'm sitting around the table every week that we call the risk committee table. There's 10 people around the table, 10 people. And I tell you, you'll be shocked at the risk that you need to address. So if you want to be in the distressed property market, come to Assist. There's no doubt. You'll be safer. I can tell you.
Great. I'll put.
Thank you.
This question obviously around does it make any sense to buy property in your personal name? And I think Rudolph, you kind of alluded where you're starting from. So maybe do you want to comment first? Yeah. So it's from Robert, and he says, does it make sense to buy property in your personal name? Yes or no?
I think if it's your first property, I think it does. It really depends on your intent for me. What's your intent with that? And yeah, if you're buying your first property, I would say buying your personal land. if it's your primary home, the house that you're living in, once again, what's your intent? If you want to live there for a long time, then you can maybe, and you have a family and someone, it's sort of once again, it's a legacy asset. Then think about setting up a trust, but if you're just buying one and you're not going to own it in 2 or 3 or 5 years, then buy it in a personal name. There's I think there's actually some tax breaks there for you during that time. But if you know it's going to be a long-term asset, then think about maybe buying a trust for your family.
Or if
So it's a very difficult answer, but if it's the first
Yes.
one, I would say yes.
Just to add to that is maybe just remember if you, for instance, start off with like tax transactions like Section 13, those type of things, 13.6, all those different options that you can utilize. And that's, I think, just adding to your answer is there's no specific way. Depending on what you want to achieve and how you want to get that journey will determine the vehicle. If it's fine, even the product will determine the vehicle. If you, for instance, going to do your first investment with us, it's okay because in 2 years you won't have it on your name. But maybe you decide thereafter that you will start holding some or whatever. Then in that case, you start doing it in another vehicle or the trust or whatever.
Yeah.
Exactly. I think that's all good.
Yeah. And I think depends is what it said. Right. Let's moving on. We've got a lot of questions here. What I'm going to do, is there anybody from the audience here right now that has a question? Is there anybody that has a burning question? Yeah. Can we just hold on for the microphone? We're going to give the microphone. We just had it.
Not
And if you
if-
could speak.
You
nice
said
and
you're not
soft.
going to ask questions tonight.
No, it's not a difficult one.
Nati, would you like to just stand up just so
Yeah.
that, yeah.
Okay.
Right.
Yeah, it's not a difficult one, honestly. Rudy, I mean, it's just some pointers, maybe, if I may put it that way. I think it would have helped if you gave us a table where you buy a property in your name, you buy a property in a company, you buy a property in a trust over, say, 1 year. Like, I think most people that are here are coming here to invest. So look at it from an investment perspective. Say, if you invest for 1 year, this is what it means in terms of return. If you invest for 5 years, this is what it means for each of those investor categories. I think it would have given us a better sense of which option really to explore.
Yeah. So Nati, I'll actually answer that question for you because, and I think Rudolph also mentioned it also depends on what your intent is. What is your, because
what I'm saying, we are here as investors, most of us. So just look at it from that perspective, that if you're investing, this is what it means for each of these.
Oh, yes, yeah. No, absolutely. But I think what I'm saying just in response to that is that if you've got a longer term plan, get your structures up front, get it sorted out right up front. Even if you get the structure done, and if your intent is to get 2, 3, 4, 5, 6, 7 properties, even over the next 20 years, get that structure done right up front. So even from the get-go is probably, if that's your intent is to grow, and that's why you've got to have the goal right up front, even if it's one property, that's fine. You can still buy it in that structure. But if year 2, you might want to get second property, year 3, etc. So just in terms of that, I don't know if you wanted to add.
I just think what Neil is trying to say out there, as well as in Rudolph's case, what I would like to do, and that's actually why we're here. We don't charge you for that. Okay. If you actually go and just sit with Gerard, you will actually, in your specific case, say this is the way, taking your income, your stuff into consideration. But that slide will give you a very unspecified overview. If you can just go to slide number, the first one of Rudolph.
Yeah, so while the slide is coming up, he said to me, and this side as well, we're not doing the calculation. It's because of the what's the word? The variances, each individual. Because if you say 350 income, versus 650 income
Exactly.
as a personal salary earner. No. What we're saying is we know. Yeah. We just wanted to. How is it? 550. 550. Okay.
So what I want to say to Nati, it was a difficult question.
Yeah. But the thing is, we know Nati by now.
Yes.
He thinks it's simple, but the reality, what I found some helpful when you look at the slide, the individual, the difference between going through the company and the individual was 3%. But the cost of running that company is going to be higher than 3%.
Definitely.
And many people come to me day one. Now I've got my company already. My trust is in place. I says, how many properties have you got? He says, no, one. I says, why? Why is it in? If you're aiming to, and I mean, the other day when we had this panel with an attorney, he said, listen, the rule of thumb is if you're buying long term, put it in a company or a trust, depending on what you're doing. If you're flipping and you're making short-term profits, put it in your personal name.
Yeah.
So depending on your personal tax brackets and all the
things like that.
interpretations, it will definitely vary. And without any doubt, it is a bit of a personal consultation. But we just wanted to bring across that thing, that the difference between that first structure, ultimately you will see the trust on a 7% level will be the best. But then by then you will be running already.
Okay, great. Let's just move on. We've got a few, and there's a lot with trusts and that kind of stuff from Merle Daniels. And Merle, so I'll give you the answer, and I'll give the rest of the team to also elaborate on it. Can trusts not be set up in such a manner where assets are protected? That's absolutely why they set up. They set up for protection first and foremost. And
legacy.
So I think maybe, I don't know if anybody wants to just elaborate on that, Rudolph, in terms of trusts and protection. I think you mentioned the estate planning benefits as well, which is an exceptional estate planning tool where the trust lives on forever, and it doesn't matter who passes, no closing of bank accounts, freezing of bank accounts, etc., and of estates and assets and all that kind of stuff. So
Look, I'm not a legal expert, but I believe that it's going to depend on who gave security for the assets in there. And if the trust gave the security, then the assets are going to be at risk.
Yeah.
If the trust did not, or that it's not financed anymore, then no, obviously fine. But it depends on who. If the trust is security for anything, it's going to be at risk. You just have to be, let's say, forward thinking about it, and not have your trust assets be security for anything.
Yeah, so I think Milt, get advice from an attorney on that one. I don't know if you want to.
Just the last point is what Rudolph said there is very important. Is if you set up your trust not to make debt, for argument's sake, then it will be more protective. Okay. So certain trusts are, if that's part of the trust rules, then in that case you can't make debt. Doesn't matter what you do. If the trust says this is it, then you can't also use mortgage. But that's fine. Then you do those transactions that you want to do a mortgage on. But when your assets, like call it your home, like in Rudy's case, which he mentioned, is paid off and it's in the trust, that's protection. Okay. And protected for whoever stays behind. So I think that answers that question.
Okay.
Yeah, maybe I can just talking about intent. I've always said that when you're buying your primary residence, just buy it in your personal name, because when you sell it, you will get that primary residence capital gains exemption of 2 million rand. And so that does make sense. But now I see that I bought my house 10 years ago, and I've kind of decided that I'm probably not going to sell it. So if I knew this 10 years before, I would have just bought it in a trust, because I know I wasn't going to sell it. But so I think that's the point of intent. When you know what's your plan, just having a plan for 5 years, 10 years, 20 years is important.
Okay, there's another tax question here. What are the tax implications of transferring shares from an operational PTY to a trust? And when is it better to hold property directly in a trust rather than in a PTY? Want to have a go at that?
Once again, I would say it's an intent in the company. If you plan to keep it, then it's probably fine. If you're going to sell it, you're going to pay capital gains tax, a large amount of capital gains tax, and you have to get the money out and paying dividends tax.
Dividend tax as well.
So if you intend to keep it, then the company is okay. What was the other question?
Shares.
The shares. So to transfer shares, you're triggering a sale of shares from the person to the
Transfer
trust.
duty.
So let's say the individual is holding the shares. Now you want to transfer to the trust. So that the individual is selling the shares to the trust. So the individual will trigger that sale will trigger capital gains tax in the individual's name. So that will be a cost for you there.
Yeah, there is ways to obviously have, when you have a lot of properties in your name and you build it up, unfortunately, and now you want to move to a company or vehicle to do that. There is ways to do that and get some, if I can call it discount to another word. Obviously, financial guys use, what's that section? 42.
Section 42 is possible, yeah.
As where you move properties from your personal name to an entity, and you won't pay the same transfer duty as you would have on the individual transactions.
Yeah, so doing that transaction, you are just delaying your capital gains tax.
Exactly.
By doing that. So, but I think that's a whole conversation on its own.
That's why, but I just want to mention that there's many things which obviously we can't touch on here. And that's why Nati's question was actually a very good question to ask, just to illustrate that each person needs to come and sit with us. We bring the financial guys in, they give you the right advice, depending on your intent, on your plan, where do you want to go in this journey and how do you want to get there? Are you going to use mortgages? Are you going to use finance? What are you doing? And that will determine where you're going, what the route to follow. Yeah.
Right. So we've got a question here from Martha. And Martha, I'm just trying to understand the first part of the question. I'm not sure if I understand it correctly, but you say you have a qualification in real estate, but most brokers won't take me without a car.
That's true.
Yeah,
That is actually true.
So I was kind of wondering, says Martha, if one can invest into property with zero capital. If yes, how can I get started? Just get started, find the property and start negotiating.
I've got a good plan,
Yes.
which Gerard should actually answer.
Yeah.
And just phone Gerard. And he will set it up for you. So basically what we will do, I don't know if you want to address the question, but
Give my phone number.
so what we will do is first of all, get your pre-approval, see what you qualify for, get your structure in line to see where you want to go, what you want to do, same thing that we already spoke about, and thereon allocate an investment to you, which falls within your strategy and plan that we've got for you, and then you can start. You actually can just phone Gerard, you can literally start tomorrow.
Yeah.
Banks are coming back with 100% bonds as well. So
Yes.
they're coming even on commercial properties. Can you
Yeah.
believe that? Yeah.
Wow,
So they're starting
that's
to come
amazing.
back. I mean, it's
Okay.
the guys down the road here.
Yeah.
So if
No.
they do it, you know what I'm
Okay.
talking about.
Yeah.
All right.
Wow.
So
Okay.
let's move on. Merle, another question. What are your thoughts about refinancing? I don't know. What are your thoughts, gentlemen?
It makes sense if you use the money to get into more property.
Not to go on holiday.
No.
Yeah, exactly. And if the investment, and I know people will tell you, okay, I can buy a buy-to-let and I pay in 2,000 Rand a month. For refinancing, don't go there. I can give you, I can just ask one of our investors here to spend a few minutes explaining where you don't want to end up by just buying new developments, and taking more mortgages, max yourself, and then on the end of the day, you sit with a challenge that you can't afford the monthly payments anymore. If you want to refinance, you need to do it conservatively, but also use that funds. Whatever transaction you do after that should be cash flow positive from day one. That's the rule. Okay. And if people tell you there's no deals like that, well, we haven't done a deal in 11 years that wasn't cash flow positive from day one. Okay.
But if there's none, save up until
Yes.
you've got enough money
Deposit so that you make it.
so that you can have
Exactly.
the risk taken out.
Exactly.
So we'll cancel that trip to Mauritius, please. All right. So Ikening has asked, do you offer management services for bonded properties?
Rental pro-
If they mean property management or asset management, definitely, I think to just summarize what we do from the moment, helping you to purchase, maybe Paul, you can answer that one. I think good idea.
Yeah, I think we put it under our portfolio of management properties. So we would go through a tenancy process of getting a tenant, vetting that tenant, putting the tenant in, collecting the monthly rent, making sure that the maintenance is up to date, making sure that the rental is paid, that you receive your monthly payments. Very important that your municipal rates are up to date. So all those things are, in short, yes, we do it, absolutely. And we do it to the benefit of you, because no investor, as Gerard alluded to earlier, wants to sit in an environment where they have to manage their own properties, because it's frustrating. You don't want to get the call at 12 o'clock at night that my light bulb is now blown or my geyser is gone, or those are our challenges that we sit with, and we have a team that deals with it on a regular basis. And I think that's very, very important.
I think to add, currently every investment that we do for you at Wealth Assist, I'm talking about now, like in our side from TPG side, I don't make a call to the tenants or anything. I don't even do any payments to mortgages, nothing. Every single thing gets paid by the asset management team, collecting, paying, doing that. If there's actions, legal actions or litigation, in some cases where you have to go to litigation, although that's our last resort, we use mediation, arbitration, only when it needs to litigation, because it's really not an answer. Then in that case, we even facilitate that on behalf of the real estate investor, obviously in cooperation with him.
Okay, great. Last question from the virtual audience, unless there's more coming through, I'm not sure. And if there's anybody here from the live audience, I'll get to you afterwards now. And from Anonymous, who can be your beneficiaries if you have no family but want to transfer wealth to persons and not a company? Anybody? Can be company, persons. Elaborate?
I would like to be.
Yes. So Anonymous, it's anybody. You can really, you decide who those beneficiaries are and you select, and it doesn't have to be direct family, just so that you understand. Okay, so let's putting it out there. I know there's, we'll just get you the microphone and then you can fire away the question.
Okay, thank you. My question is more on the fees that will assistance with all the product that you are bringing on the table.
Yeah, I missed that.
The fees. Yeah, what are your fees?
Question on the
that's a
fees.
very good question. I'm glad somebody asked that one. Andile, yeah. So I think from Gerard's side, he can explain the fees on, and Paul, you can maybe just touch on the fees with regards to the deals, but just on any transaction, we actually, all the fees are included. As from owner's perspective, it's very similar to estate agencies and that type of thing, collection fees, all those type of things. But whatever we quote, if you go to our website and you see there's a 17% yield, that's after cost. It's your net yield. Okay. So whatever you see is excluded. Paul can explain a bit more on that. On what part is from that side on the collection and within that, but what you see is the net. On the investment side, Gerard, you can explain what the external buyer's fee.
Well, basically what it comes down to is that if you're using a bond, as a cost to you as an investor, you will actually have to pay the bond registration fees. And the once-off initial fee to Wealth Assist, depending on if you're doing a 1 year or 2 year deal, it works out to 1.75% per annum. but it's paid up front. So if it's a 2-year deal, it's going to be 3.5%, but it's a once-off upfront on the deal, and we work out the returns of the investor after those costs on an investment perspective.
So what he says is if you get 17% net yield, that means the gross return. If it's 1.75, it's actually 18.75 if you get the message. So your return is actually 18.75. And then after the cost, you end up with 17% per annum. Okay.
More questions there? Somebody want? Yes, we got there. Just the microphone.
Thanks. So I just have 2 questions. The first one would be, how often would investments become available since it's rolling for, say, 2 years? And then the second question would be, why not focusing just on institutional investors rather than including retail investors?
That's a good question.
So, say again, it's the difference.
Yeah, hoekom doen ons nie net institutional nie?
Oh,
Versus
okay. That's I'll start with that question because it's a vision question, and I will leave the next stuff, the previous one, to you to answer. So from our side, we first of all want to help investors to create wealth. So if you read our vision and our mission statement we actually also helping owners. So we like the impact side of things, which for us, we want to make a difference in the life of the real estate owner, the real estate investor, as well as all the role players in the package. And if you only work with institutional investors, personally, I don't know, everybody knows about 2008, the credit crunch. Although institutional investors has got the most money, they're also the first people that pull the plug. So we never want to rely only on institutional investors, but we also want to build wealth for private retail investors, which is substantially more work, like you mentioned. And some people don't understand it, but currently we probably at we would say about 30 to 70%, call it the 50% ratio, which obviously in the future, the institutional will be much higher, but we will always have private real estate investors to help to build the wealth for them, but also they are the backbone of the future when it comes to difficult times and those type of things.
I think the other thing between the difference is the institutional guys don't want to finance.
Oh, yes.
So the personal guys can always finance.
Can
So
finance.
that tips it back. So the answer is in terms of how many, that depends on Paul and his team. So the reality is about, we know that we need to do about 12 per month, to
make financial sense.
Yeah, otherwise it just doesn't make sense.
No.
It is a costly exercise. So there should be enough, but I mean, if I look at the feedback that we got today, it seems that they are bumping it up and it will be bigger in numbers.
Just another point you could add, a lot of institutional investors prefer to buy an entire
Bulk.
development
Yes.
as opposed to individual properties as well.
Very good
So
point.
I think there's like multifamily, but they call it multifamily in South
Yes.
Africa, believe it or not. And what they do is they buy a development or they develop from scratch and they just manage those properties for themselves.
Yeah, rent it out.
So they become the investor. So yeah, and I think you're really trying to help people, out there, who are
Exactly.
starting out from an investment perspective. So was there a second part? Have we answered your second part of the question? We've done it? Okay, you happy with that? Any more questions from the audience? Yes, please. Yeah.
Hi there. I've recently bought my first property. Although property isn't just going to be my focus, I'd like to diversify my portfolio. But my ideal would be to have around about 5, be it maybe small houses and apartments. And getting back to what you said earlier, with financial gearing only makes sense when you have positive cash flow. And I totally agree with that. In my headspace, so I've got an access bond, and with everything else that I'm trying to invest in, or not trying, I am investing in, I'm trying to, of course, pay into my access bond. In my head, it'll make sense if I maybe have 10% of the property's cost to then try and make a move. Would you think that is fine, or should it be a little more? Is that maybe overkill? What's your suggestion?
So sorry, I just want to understand. You're saying the 10%?
Of the value of the property
That you're buying.
I'd like to have as like cash flow within
Excess cash flow
within
to
the access
mortgage.
bond. Yes, so that in case, say for instance, I were to rent it out, then I have a year or year and a half's worth of payments actually. So I have that liquidity.
I understand. So that's a good approach. I think like what we do, just to give you a good example, our ratio on 12, let's call it, you pay prime. Okay, you pay 11.5%. Most people here probably pay less, but let's call it 11.5%. Our investments are always prime plus 3 net monthly yield, prime plus 3 yearly, obviously payable monthly. Okay. So if you pay 11.5, you'll get 14.5 as net yield. So you'll be 3% above your expense, even if you use 100% of your access money to buy that type of deal, you'll be cash positive by 3%. That's literally what it means. So if you work on 12%, 10% is 1.2. So Wealth Assist is the right place for you because it's actually not 10, it's 20%.
Good. All right, we've almost, I'm prepared to take one more question if there is one more. Otherwise, we're going to have to close because I know we're a little bit over time and probably our online audience is ready for bed. And so I'm not quite sure yet, but is there one more question? If there was a question, what would it be? Anybody? And we're going to have an auction going in. We'll have the opportunity to, obviously, fortunately, not for the online audience, but if you do have a question, you can send it through to us. We will deal with those questions. And obviously, our live audience, we will have a little bit of a break and a time to mix. So that's the advantage of coming to the live event, ladies and gents. So in closing, I want to thank very much our team from Wealth Assist, starting from Daniel Lombard, Gerard van der Westhuizen, Rudolf Mathieu, who's our tax expert, and of course, Paul van Niekerk. And I think they all deserve a round of applause. So thank you very much. And to you, our online audience, please join us on Thursday, 12 o'clock. Just go to rei.co.za. It's our weekly webinar from 12 to 1. We're talking about affordable housing in South Africa, which is driving investment throughout South Africa. So watch that space. Very interesting. Just log on. It's free. And we've got an incredible lineup this Thursday. So please join us for that one. And for the rest of you, I'd just like to say thank you again, once again, to Wealth Assist and the team. I think it's a great discussion. And thank you, the audience, for all your questions. We look to, probably this is our last one for this year, I would assume. And we'll be back certainly in the first quarter of 2025. We try to aim to do this every quarter alongside Wealth Assist. So thank you very much. And so this is the Wealth Assist team and Neil Peterson from Real Estate Investor signing out. Goodbye, everybody, and good evening.